Okay, let's go ahead and get started, and hopefully folks can continue to join us. Good afternoon, everyone. Thank you very much for joining us today for this training on Emergency Solutions Grant, or ESG compliance, focused on eligible uses of ESG rapid rehousing funding. My name is Monica Porter, and I'm joined today by my colleagues Sasha Kane and Nicole Thomas. We work at Homebase, a nonprofit organization hopefully you're familiar with by now. We provide technical assistance and training to the Office of Supportive Housing and Housing and Homeless Service Providers in Santa Clara County. We are recording this training, and we will make the recordings available on the COC website. We've also sent out the slides for this training, so you should have them in your email. And for folks who've been trickling in, welcome again to our final in this series on ESG rapid rehousing compliance. So let's go ahead and go over our agenda for today. We'll be covering a number of topics this afternoon related to ESG eligible costs. This will be an overview, and we will be focusing on rapid rehousing, rental assistance, and supportive services. I'll then turn it over to Nicole to talk with us about administrative costs and to take us through a modeling activity to explore whether different costs are eligible. And finally, Sasha will be talking with us about indirect costs, record keeping, and reporting. Couple of housekeeping and tech reminders. You are all muted for now, and we ask that you please stay muted to cut down on background noise. If you do have questions during the training or are having any technical issues, we invite you to use the chat box to message one of us at Homebase directly or send a message to everyone. And we will be monitoring that throughout the training and pausing periodically to address any content questions. As I noted a moment ago, we are recording this training, but the chat box will not be recorded. So just to get us all situated, to find the chat box today, if you are on a computer, use your mouse to hover over your screen, and a bar similar to one on the slide should pop up at the bottom with a chat option somewhere in the middle. If you're joining us on a phone, in the bottom right corner of your screen, there should be 3 dots to select more, and there'll be a pop-up menu with chat as an option. So, hi Michelle, glad you found the chat. So let's do a quick icebreaker to get us started and help everybody find the chat box. I don't know about where you all are, but in Berkeley, it's a nice rainy day, and I'm curious for any recommendations for good movies or TV shows that anyone has seen recently. So go ahead and find the chat. And if you've got any recommendations for movies or TV shows you've enjoyed recently, we'd love to hear about that. The Crown, yes. Below Deck, Queen's Gambit, Homeland. Awesome, yeah. Netflix is being very strong, especially lately. Great. Ooh, The Help, Living Singles, Away, Chicago 7. Awesome. Thanks, everybody. Ooh, DreamWorks Abominable. That sounds fun. Cool. So thanks, everybody, and please keep them coming. We will be monitoring the chat for additional recommendations. But to move forward with resources, in addition to today's training, there's a number of resources that provide information relevant to Emergency Solutions Grant compliance. Coming your way soon is a toolkit on Rental Assistance Program Administration, or RAPA for short. Also, COC eligibility documentation forms available on the COC website, the HUD Exchange website, and we'll be referencing that a few times this afternoon, the ESG program interim rule, and of course, you're always welcome to email us at Homebase if you have any questions, and we're happy to look into things for you. So let's get started with eligible ESG program costs. Our first slide today has a handy mnemonic to remember that generally all costs that are charged to federal funding, including ESG grants, must follow RADAR. R, reasonable, so necessary and directly related to the applicable grant. A, allowable under the interim rule and directly benefiting the program participant. D, documented, and acceptable documentation includes things like voided checks, paid bills, certified payrolls, time and attendance records. A, allocable, so incurred directly for the purposes of a specific grant, contract, or program. And finally, R, reimbursable, so part of the budget and incurred within the eligible time frame. RADAR, radar. So specific to ESG, the categories of ESG eligible costs are street outreach, emergency shelter, prevention, rapid rehousing assistance, HMIS, and administrative activities. As I mentioned before, we're going to focus today on rapid rehousing and rental assistance. So let's get started. Rapid rehousing programs may use ESG funds to provide housing, relocation, and stabilization services, and short and/or medium-term rental assistance to the extent that they're necessary to help an individual or family experiencing homelessness to move as quickly as possible into permanent housing and achieve stability in that housing. And staff salaries related to time spent carrying out these eligible activities is also eligible. Next slide, please. Rapid rehousing rental assistance may take several forms: short-term rental assistance, medium-term rental assistance, payment of rental arrears, or any combination of the three, so long as the total does not exceed 24 months during any 3-year period. Programs have discretion to set caps, including on the total amount of assistance, the total amount of time assistance is provided, or the total number of times a participant may receive rental assistance. And programs may require participants to share in the costs of rent. Next slide, please. For purposes of calculating rent, rent includes the sum of the total monthly rent for the unit, any fees that are required for occupancy under the lease, and if the tenant pays separately for utilities, the monthly allowance for utilities established by the Public Housing Authority for that area. A few additional notes here. Rental assistance provided with ESG funding generally must comply with habitability standards, which we discussed in detail on our ESG compliance training last week, and we'll be making that recording available on the COC website if you weren't able to make it. The second note here is that programs cannot use ESG funding for rental assistance to a household that's receiving rental assistance from another public source for that same time period. The exception, though, is for 6 months of arrears, which is allowable. And ESG rental assistance must comply with fair market rent and rent reasonableness. Before we explore those terms further, I just want to flag that in response to COVID-19, as you may already know, HUD has issued a number of waivers for COC and ESG programs. And one of those is a temporary waiver on the FMR or fair market rent restriction for ESG programs. So you're going to want to check in with your agency lead on whether your program is using this waiver. But even if you do use this waiver, programs still have to comply with rent reasonableness. Are there any questions so far? Okay, we'll go ahead and proceed, and please do feel free to use the chat if any questions come up. So to start, fair market rent, or FMR, is a HUD established estimate of gross rent that includes both rent and utilities, with the exception of telephone, internet, and cable. Fair market rent is calculated for metro and non-metropolitan areas nationwide, and it's based on a standard calculation and updated annually in October. On the next slide, we'll see a sample of numbers from HUD's website, which is linked at the bottom of the slide, and it provides fair market rent for many years. these are the numbers for the San Jose, Sunnyvale, or Santa Clara area. And last month, HUD published the numbers for 2021. So fair market rent is pretty straightforward. On the next slide, let's start talking about rent reasonableness. Rent reasonableness is meant to ensure that rent for ESG assisted units are reasonably priced as compared to rents paid for unassisted units that are in a similar location, of a similar size, quality, and age, and offer similar amenities and utilities. Next slide, please. The COC's rent reasonableness policy is available on the COC's website on the COC Toolkit page. As the policy notes, providers contracted by OSH can adopt this policy or provide their own rent reasonableness policy for OSH approval. The purpose of the rent reasonableness standard is to ensure that program paid rents are reasonable in relation to rents charged for comparable units in the same market. To determine whether a unit meets rent reasonableness, a review needs to be conducted and documented. Next slide, please. One method of confirming rent reasonableness is to conduct a market study. Another is to compare the unit that the participant would like to rent with 3 units that are comparable. Again, comparable being having a similar location, size, quality, age, amenities, and utilities. It's important to ensure that any comparison you conduct is up to date and reflects the current rental market. Also, that the comparison be documented, including by printing out unit listings and attaching them to the comparison form. On the next slide, we'll take a look at this form that we've got. So for those who decide to go the comparison route, the COC has a rent reasonableness checklist and certification to put units side by side. We went through this checklist in some detail in our COC compliance training on housing this past summer, and the recording of that is available on the COC's website. And there's also a user guide on the COC website that walks you through how to fill out this checklist, such as identifying what kind of amenities you would consider in determining whether a unit is comparable. Next slide, please. So to recap, rental assistance provided with ESG funding generally must comply with fair market rent and rent reasonableness, with the possible exception of a HUD waiver of the FMR requirement during the COVID-19 pandemic. This slide provides a summary of the main points that we've covered and resources for additional information from HUD and the COC. Are there any questions so far? Alrighty, we can go ahead and go on to the next slide. Thanks, Pamela. So now that we know how much rental assistance we can provide, let's talk about rental agreements and lease requirements. And both of these need to be in place. So first, rental assistance agreements. Programs can make rental assistance payments only with an owner with whom the program has entered into a rental assistance agreement, which might also be known as a housing assistance payment contract. Rental assistance agreements must be between the owner and the program. It has to set terms under which the rental assistance will be provided, contain the same sorts of terms such as payment due date and grace period and any penalty requirements as the program participant's lease. And the rental assistance agreement understandably would terminate if the participant were to move out, or the lease terminates, or the participant becomes ineligible for ESG assistance. In addition to rental assistance agreements, leases must be between the owner and the program participant. They must be legally binding and a written lease, unless the rental assistance is for rental arrears only. Both rental assistance agreements and leases must include all applicable protections under VAWA, the Violence Against Women Act. And finally, in the event of any late payments, programs are solely responsible for paying any late payment penalties that it incurs with non-ESG funds. Next slide, please. In addition to providing assistance with rent, programs can provide a variety of financial assistance with ESG funding. This includes rental application fees, security deposits up to 2 months of rent, last month's rent, if necessary in order to obtain housing for a program participant, utility deposits to the extent that they're required by a utility company, utility payments for up to 24 months and including up to 6 months of utility arrears. And a quick note here, the member of the client household does need to have the account in their name with a utility company or proof of responsibility in order to make utility payments. And then last two, you can use ESG funding for moving costs, such as for a truck rental, moving company, or temporary storage fees. Or for clients receiving ESG rental assistance, ESG funds can be used for emergency transfers to pay any amounts owed for breaking a lease to effect an emergency transfer. And these costs are not subject to the 24-month limit on rental assistance. So there's a lot on this slide. The toolkit that we've got coming out has a great resource with a really handy table, which we're going to look at more in just a bit. So let's take a break to do a quick comprehension check. Which of these is an eligible ESG rapid rehousing financial assistance cost? And we'll go ahead and launch a poll here. Is it A, one-time payment of rental arrears, B, rental application fee, C, security deposit, D, utility payments, or E, all of the above? And we'll give folks a bit to weigh in on this poll.
So there are a couple of questions in the chat I can read out, Monica.
Great.
This being, if we have a client that moved out and owes back rent on his part, can we get assistance to bring to date in order to keep them in good standing on a credit report?
Great. So I think, yeah, we did cover rental arrears can be up to 6 months. Is that right? Would that be helpful for that question? I'm sorry, I couldn't see it.
So we have another question, just what is an arrear?
Great question. So an arrear is a sort of back payment. So that's if folks have payments that are sort of building up and you need to make a payment for something that was past due. So it's possible to make rental arrears payments or utility payments that are for payments that are past due.
Great, Michelle said that answers your question. And there's one other question about if the tenant vacates without our knowledge and the landlord also does not say anything to the agency, yet we keep paying the subsidy, does the landlord have to repay the subsidy?
Oh, that's a really good question. I think that's one that we'll want to look into and get back to you on. Thanks for flagging that one.
So as part of the RAPA toolkit, we are going to be providing a sample HAP contract, so we can explicitly address that in that. Thank you for the question, Benjamin.
Awesome, thank you, Nicole. Great, and to revisit our comprehension check, thank you. All of the above types of costs are eligible under ESG rapid rehousing financial assistance. So you can include rental arrears for one time rental application fee, security deposit, or utility payments. Great. So now we can move on to housing, relocation, and stabilization and services costs. So in addition to financial assistance costs, eligible ESG service costs are the following: housing search and placement, housing stability case management, mediation, legal services, and credit repair. So let's take a look at each of these in turn. The first category is housing search and placement, which means services or activities necessary to assist program participants in locating, obtaining, and retaining suitable permanent housing, including things like housing searches, outreach to landlords, and tenant counseling. Next slide, please. The second category is housing stability case management. ESG funds can be used to pay costs of coordinating services to facilitate housing stability for a participant who resides in permanent housing, or to assist a participant in overcoming immediate barriers to obtaining housing. This includes services like counseling, monitoring, and conducting re-evaluations to determine how the client is progressing through the program. This assistance cannot exceed 30 days during the period the program participant is seeking permanent housing, and it cannot exceed 24 months during the period that the program participant is living in permanent housing. Next slide, please. The third category of eligible housing, relocation, and stabilization services is legal services. Here, eligible subject matters include things like child support, guardianship, emancipation, legal separation, and landlord-tenant disputes. It does not include topics such as immigration and citizenship matters, issues regarding mortgages, or retainer fee arrangements or contingency fee arrangements. The final two categories on the next slide are mediation and credit repair. ESG funds can pay for mediation between a participant and their landlord, or between a participant and people that they're living with. Mediation costs must be necessary to prevent the participant from losing housing. ESG funds can also pay for credit counseling and other services necessary to assist participants with critical skills related to things like budgeting or resolving credit problems. And an ineligible cost would be payment or modification of a debt. So we've gone over a lot here, so let's pause to check in with one more example. So in this example, a case manager has a rapid rehousing client that needs help filling out rental applications. Can you use ESG funds to pay for the case manager's staff time in helping a client to fill out rental applications? So let's go ahead and launch that poll. And while we're waiting for folks to weigh in on the poll, just want to circle back to a question that we addressed just a moment ago. We do want to relay that OSH expects that agencies will be making efforts to get funds that are incorrectly collected as rent from any landlord since the client has vacated. And as Nicole mentioned, we will be sure to address that in our upcoming toolkit. Great. And we see that for most folks, the answer is yes, and that is indeed the right answer, but all answers are good because they're an opportunity for us to review. So the answer here is yes, you can use ESG funds to pay for a case manager's staff time helping a client fill out rental applications. Services or activities that are necessary to assist program participants in locating, obtaining, and retaining suitable permanent housing are eligible ESG costs. This includes assistance with submitting rental applications and understanding leases. And staff time that's related to time spent carrying out eligible activities is itself also an eligible cost. So now I'll go ahead and hand it over to Nicole to talk with us about administrative costs.
Thanks, Monica. So administrative costs are its own line item. We often think of admin costs generally as the same as overhead or indirect costs, and that admin costs are the costs of running the agency. But in the ESG context, when you have an admin line item, it's intended to cover a specific set of administrative costs itemized in the ESG regs. So an admin budget line item can cover general management, oversight and coordination, reporting on the program, the costs of providing training on ESG requirements and attending HUD-sponsored ESG trainings, the costs of preparing and amending the ESG and homelessness related sections of consolidated plans, and the costs of carrying out environmental review responsibilities. In general, the staff or personnel costs of doing these eligible activities are eligible as part of that activity. For example, staff time spent administering rental assistance has to be billed to rental assistance, not to admin. Next slide, please. General management oversight and coordination includes salaries, wages, and related costs of staff engaged in program administration, such as preparing and amending program budgets and schedules, and monitoring program activities for progress and compliance with program requirements. Now, this is a fairly long list, so when you're determining what to put in the admin cost bucket, it can be helpful to reference this slide and see if the specific cost you want to be charging is included here. Next slide, please. General management, oversight, and coordination also includes travel costs incurred for monitoring of subrecipients, administrative services such as general legal services, accounting services, and audit services, and other costs for goods or services that are required for administering the program. So this could include renting or purchasing equipment, insurance, utilities, and office supplies. Next slide, please. So on the last slide, we saw general legal services being an eligible admin cost. You can't bill all of your general legal services across your agency necessarily to your ESG grant if it's a shared cost. These are costs that benefit more than one grant activity or funding stream that can't be reasonably directly tracked to each activity. A number of costs in your program budget are likely to be prorated and might be divided across contracts. You have to allocate costs based on the actual expenses you incurred for that staff time. You can't allocate it as a budget projection, and it must be allocated based on some reasonable estimate of the benefit to your ESG grant. And to do that, you're going to want to have a written cost allocation plan. A cost allocation plan summarizes in writing the methods and procedures that an organization uses to allocate costs to grants and programs. We'll go over the cost allocation plans you can choose from a little bit later with the decision tree. Next slide, please. So allocated costs can be tricky, and I want to highlight one of the resources that will be available to you that can really help in thinking through and understanding allocated shared costs. So this screenshot it's a screenshot of a document that's going to be essentially a glossary of key terms. And we encourage you to reference this and familiarize yourself with these terms before working through other resources we're going to highlight later on. Next slide, please. So now we're just going to have a quick comprehension check. Which option best describes the costs you can cover with your ESG admin line item? I'm going to launch a poll. Is it A, an agency's overhead costs, B, an agency's personnel costs, or C, specific administrative activities described in the ESG regulations? I see some answers trickling in. I'll give it a few more seconds. Okay, so a majority of people said C, and that's correct. It's specific administrative activities described in the ESG regulations. You can't necessarily cover all of your agency's overhead costs or personnel costs, even if they may be overhead costs that benefit the grant. You can't cover it with an ESG grant unless it's eligible. So if it's ineligible, you'll have to find another way to cover them. Next slide, please. Are there any questions before we move on? Okay, I'll keep monitoring the chat in case there are any, but we're going to move on to a modeling activity now. And I will start my screen share. So this is one of the documents that and resources that will be available as part of the RAPA toolkit. This is an ESG eligible program expenses chart. And we're going to do a small modeling activity and a small walkthrough to model how you can use this resource to help match budget line items with eligible cost categories. So you're back at work and your first budget line item is 3 months of rental arrears for a client to prevent eviction. Now again, either this streamlined ESG eligible program expenses chart or the slides earlier in the slide deck are both useful references and resources to help aid you with identifying how to match this line item with a cost category. Now, if you're familiar with COC eligible expenses, you might remember that COC funds can't pay for rental arrears. And then you might think that similarly, this would be an ineligible expense under an ESG grant. But if we look at this chart on page 1, we see that ESG funds can pay for rental arrears. So ESG funds may be used to make a one-time payment for up to 6 months of rent in arrears, including any late fees on those arrears. And our budget line item was 3 months of rental arrears for a client to prevent eviction. So we're good here. If you weren't using this, you could also go back to the slide deck, and Monica had mentioned earlier on that rental arrears were an eligible cost. Our next example is going to be staff time spent conducting landlord outreach. Now, with this, we might immediately scroll down to administrative activities. We might do this because we're inclined to think of all staff time as general personnel costs, but we can then rule it out because it's staff time directly spent on an eligible activity. So now we're going to scroll up to service costs. And here we'll see outreach to and negotiation with owners. And furthermore, you'll see at the top of this section, it notes that this covers salary of staff who directly deliver the services. So now we know where to match staff time spent conducting landlord outreach. So that was just a quick preview of how you might use some of these resources to help you. Are there any questions? Okay, if there aren't any questions, I'm going to hand it over to Sasha to cover indirect costs.
Thanks, Nicole. So in terms of direct and indirect costs, this is another area that can be kind of tricky. And so we're going to be rolling out some tools within the RAPA toolkit with both definitions of the different types of costs and a decision tree to help sort through how to allocate them, which we'll preview in a few minutes. So just to dive into direct and indirect, direct costs are costs that can be identified specifically with a particular cost objective, like a federal award or another either internally or externally funded activity. or they're costs that can be directly assigned to these activities pretty easily with a high degree of accuracy. Indirect costs are pretty much just the opposite of that. So they're costs that are incurred for common or joint purpose. So they benefit more than one cost objective. And it's not so easy to assign them to the cost objectives that they benefit without having disproportionate results. And in order to equitably distribute indirect costs to the cost objectives, you might need to form various pools of indirect costs. And then those pools will be distributed to their objectives, such as different projects, based on ways that result in equitable distribution of their relative benefits. So there's no universal rule for classifying costs as either direct or indirect under every single accounting system. So what that means is a cost might be direct with respect to some service or function, or indirect with respect to the federal award or another final cost objective. So overall, it's essential that each item of cost incurred for the same purpose be treated consistently in like circumstances as either direct or indirect in order to avoid double charging your federal awards. Indirect costs, I think I've gone over most of this, but they're governed by the uniform guidance issued by the Office of Management and Budget, and they provide the ability to charge shared overhead costs that are challenging to directly allocate to a grant month by month or quarter by quarter. So again, they're incurred for a common purpose. So an example might be general legal costs for your agency, and those types of things benefit more than one objective. They benefit more than one grant, more than one project, and it can be difficult to track two individual projects. So they're similar to shared costs, and the categories can overlap. So if you have a cost that can be a shared cost directly billed to a line item, you have to pick and be consistent. In terms of the different options for indirect cost rates, if you're going to be using an indirect cost option, you have to have an indirect cost rate. And there are two different types. There's the 10% de minimis rate, and this is typically available to recipients that have never negotiated an indirect cost rate with one of the agencies that grants them money. But for ESG, actually, subrecipients are not allowed to use the de minimis rate. So OSH subrecipients, which for the ESG funding that we're talking about, that covers everyone, can't use that 10% rate. So that means that agencies have to use the negotiated indirect cost rate. So that's something that you would negotiate with a cognizant agency, typically the agency holding your largest grant. And one important thing to remember is that this isn't a line item in your budget, and it's just an approach to covering those indirect costs that are difficult to allocate to one project or another. So you have line items in your grant that equal up to your full grant amount, and the indirect costs are basically a percentage of those specific eligible direct costs, those specific eligible line items. So the way to charge indirect costs is to identify direct costs in a particular line items that fall within the direct cost base, and then apply that negotiated indirect cost rate to the line item and include that in the invoice. So you can never exceed the total amount of that grant line item, but some portion of it can be used as indirect. And that brings us to the RAPA toolkit, that decision tree that I mentioned just a minute ago. So once you've familiarized yourself with some of the definitions of all of these terms, we have this decision tree resource in the RAPA toolkit. And the first question that you, where did my cursor go? Oh, looks like I lost the red thing, but the first question is always to ask if the cost is eligible under the ESG grant. And if it's not, then your shared cost has to be allocated among all programs that were benefited by the cost. So even if the cost isn't something that's eligible for ESG, for the ESG project, part of it still has to be allocated to that project, even though you're not going to be able to get reimbursed from ESG funding. So if it is eligible, then you're on this side, which is the majority of the decision tree. So there's two distinct approaches, and you can allocate the cost as a direct or an indirect cost based on specific allocation plans. And so it's important to note that an agency can use both direct and indirect cost approaches simultaneously and allocate some shared costs directly to the grant and include other costs in an indirect cost rate. But remember that you have to treat each type of shared costs consistently. So if you're allocating a particular cost as direct under one federal grant, then other costs of the same type have to be allocated as direct costs and can never be treated as an indirect cost. So for each cost, you'll want to pick an allocation base that results in the least distortion of its proportionate benefit. So if you look at cost allocation plans and say you're trying to work through how to allocate staff time across working different programs. So in this case, we can look at percentage of staff time, or FTE. And in order to allocate based on staff time spent on, in order to allocate based on staff time, you'll want to first determine which programs or activities the benefited from the shared costs. So which programs would you say that the staff's efforts went towards? And then you'll want to calculate the percentage of the overall staff time that was spent on each of those projects or cost objectives. So the shared costs for the first quarter, for example, should be allocated based on percentages of first quarter staff time. And you could provisionally look forward and allocate costs based on a previous time period. But then if you do that, you'll want to adjust or correct the allocation to reflect how the actual time was spent. Again, here we highlight that under the indirect cost approach, OSH subs can't use the 10% de minimis rate. You could also recalculate the allocation base each time the costs are reported out or invoiced. So for example, with the cost of administering an agency's payroll, you might allocate that based on the amount of staff time spent on each objective. And because the benefit of payroll admin is directly related to the number of FTEs assigned to each cost objective. So if you allocated payroll costs in proportion to program expenditures, for example, rather than staff time, that would create greater distortion. Administering payroll for a certain number of employees has the same benefit regardless of the overall amount of program expenditures. So here we come to another quick poll question. If your agency is interested in drawing down or invoicing indirect costs, what would be a good next step to get you started? Would that be A, reach out to Homebase for more info, B, consult an accountant or auditor with expertise in federal grant compliance, C, reach out to the field office, or D, any and all of the above? Give it just a couple more seconds. All right, looks like most folks submitted any and all of the above, and that is again the best answer here. And we just wanted to highlight all of the different ways that you can get more information, whether that's reaching out to us and reaching out to an auditor and the field office to get more information, because I know that these, especially with indirect costs, this can get really tricky really fast, and want to make sure that you get the questions answered. So any questions about all of the stuff that I just covered? We're always happy to take questions later. I know once you have some time to actually sit with that decision tree, questions might come up. Once you're actually looking at some costs in front of you, you might say, oh, well, where does this fall? We're always happy to go over examples, go over your costs. So, okay, that was the hardest part. Now we're going to get to some record keeping and reporting requirements, which are a little bit simpler. So basically, financial records and the documents supporting them have to be retained for 5 years from the date of the submission of the financial report. And the records have to include copies of all leases and rental assistance agreements. For the provision of rental assistance, you have to include documentation of payments that were made to owners. They also have to include supporting documentation for these payments, including dates of occupancy by program participants. The records also have to document the monthly allowance for utilities, excluding phone, and used to determine compliance with the rent restriction. You must keep records of the types of essential services and rental assistance and housing stabilization and relocation services that you provided, and the amounts spent on these services and assistance. The records must include supporting documentation basically for all costs charged to the ESG grant. And the goal is to demonstrate that the ESG grant funds were spent on allowable costs. So you have to retain records of things like the receipts, and also even receipt and use of program income. That is all included here. And we want to chat a bit about timekeeping. So this one is an area that HUD monitors pretty frequently. And basically, if you can't pull it easily for HUD monitoring, it doesn't help the agency. And HUD, the agency has to demonstrate to HUD that you are able to monitor this documentation regularly and easily yourself. And so we're going to talk about time and activity reports and also timesheets. And we'll start with timesheets because really what these enable agencies to do is to clarify personnel costs. And with timesheets, also employees spend less time trying to figure out what actually happened, and they allow you to draw down funds accurately and avoid monitoring findings, because without timesheets, it becomes difficult to provide time and activity reports and to provide accurate reimbursement requests. And in cases where there are monitoring findings, the agency might have to pay back grant funds. So it's important to build in the time to do it and find an approach that works for you. Typically, HUD-funded program staff have a lot of responsibilities, and I know you know so well, you work on so many projects, and for that reason, it's really important that the documentation of your time follows certain parameters. So that means that The documentation of staff costs and time has to support the distribution of your salary among specific activities or cost objectives. So you have to be able to track your time to eligible costs and to the grant that you're working on and to eligible clients. And it has to be incorporated into the agency's official records, and it has to reflect all of your time. So the costs, the time and activity reports basically have to reflect all of the activity for which you are compensated. And it has to be supported by internal controls within the agency and to be compliant with accounting policies and practices. And documenting time requires that time and activity reports are prepared at least monthly. They have to be signed and dated by the employee and the supervisor. They have to track actual hours worked as opposed to, okay, so I worked 8 hours and I worked about a quarter of my time on this project and a quarter of my time on that project. No, it has to be exact hours. And they have to actually also track ineligible costs. So like this goes back to what I was saying just a minute ago, in that the time and activity reports have to include everything that you were compensated for. So whether that's eligible or ineligible. So if there was fundraising or general staff meetings or conferences, those kinds of ineligible costs also have to be in the time and activity reports in addition to the eligible costs. Really important, they have to demonstrate that the distribution of staff time between multiple program activities. So you have to show time spent on case management versus educational services versus admin activities. And they have to demonstrate the distribution between multiple funding sources. So if you're working on HUD grant number 1 today, and then HUD grant number 2 later this afternoon, or a foundation grant later in time. Basically, the time has to be tracked to the specific activity that you're doing, the client that you're working on, and the grant. Some of the most important takeaways here is that the invoices have to match the timesheets, have to match the case notes. And as I mentioned, tracking by grant, client, and eligible activity is key, and including both eligible and non-eligible activities. Some of the most common timekeeping mistakes that come up in HUD monitoring are things like billing a whole day to one grant. Sometimes that might be the case, but typically folks are working on more than one grant per day. So also billing a fixed percentage of time to a grant. So because timekeeping has to reflect the actual way that you spent your day, having a fixed percentage doesn't work. Not reconciling time and activity reporting with invoicing, and excluding ineligible costs, or excluding sick and vacation time, or missing documentation to accompany the reporting. So missing timesheets to back up time and activity reporting. I'm going to stop sharing to preview another RAPA toolkit item. So we've developed a sample time and activity log, which we'll distribute with the other RAPA toolkit materials that we've previewed today. And basically, this is just a way to keep track of time and make sure that you're reporting based on the things that we mentioned. So here you might have a drop down of different programs. And then under the time spent on each cost category, it'll have a drop down of cost categories that are eligible under ESG grants. So housing search, mediation, legal services, all the stuff that we talked about earlier, basically to facilitate tracking time to those costs. And we'll include We'll include another one here for things that are not ESG eligible, since those also have to be tracked in time and activity reports. And finally, the other item is the client initials. So hopefully having some sort of template like this to build off of might be helpful in complying with those requirements. Go back to the PowerPoint. Any questions about record keeping or time and activity reports? Oh, I do want to, thanks for flagging, Nicole. Some agencies, we know that some agencies do time and activity tracking as part of their time cards. So these can be, sometimes these are one and the same, and sometimes there are separate things. So we just do want to acknowledge that sometimes the timesheets and the time and activity tracking are one and the same. We're always happy to take questions via email, offline, at our office hours, which I'm trying to pull up. Our next office hours are actually tomorrow morning at 10 a.m. They're on the COC calendar. They're always on the COC calendar. We have them every month. So you're welcome to pop into those to ask any questions, or to email us directly to our team email, or give us a call. But thank you for attending the training, and we'll have a brief feedback survey that we're hoping that you'll fill out. And we do read each and every single response, and so we'll hope that you take a minute to give us some feedback or your thoughts about how we did and how we can improve the trainings. We'll send that out via email, and I think also, let's see, I can't see the chat, but
I popped it in the chat.
Yep, Nicole sent it in the chat. Thank you.
Thank you.
Thanks, everyone.